Hello, everyone, and welcome. My name is Elliot Gu, and it's September 2018, late September 2018. And today's issue of Deep Dive Investing, I'm going to go through something that's very important. We've talked about this topic in various ways in Deep Dive Investing in several past issues, but I want to go into a little bit more granularity, a little bit more detail this time. And specifically, I want to look at the stock market and economic cycle and what the different stages of the stock market and economic cycle are. In other words, what's meant by early cycle, what's meant by mid cycle, what's meant by late cycle, and what, of course, is meant by a recessionary bear market. Also, what kind of stocks tend to work best at each stages of the cycle. I say this is very important because if you can tell where you are in the economic cycle at any given time, where you are in the market cycle at any given time, that can help point you towards characteristics to look for in stocks that you want to buy, characteristics you want to look for in stocks that you want to sell or sell short, and it can give you an idea how much more of a rally you have ahead of you, what kind of a rally you should expect out of the stock market, and really just point you in the right direction. It's not an exact roadmap. Every cycle is a little bit different, but you can glean a lot of information by parsing the data, parsing the economic and market data, and trying to figure out where we are on this cycle roadmap. And that's what I want to talk about today. So the easiest way to do that, I think, is to start with an example. And I want to start with what the stock market and economy did between about 2000 and 2008. 2000, of course, was the tail end of the big 1990s boom, where the economy saw a record-long expansion up until March of 2001 when it actually entered recession, the U.S. economy. The stock market also, of course, saw a boom. From 2001 until 2002 and early 2003, U.S. stock market was in a bear market. There was another bull market from 2002, 2003 lows all the way up until late 2007. And then, of course, this period also includes the beginning of the 2007 to 2009 Great Recession and bear market. So just looking at the stock market itself, the S&P 500 did peak in March of 2000 at around 1550, at a level of around 1550. But as you can see, even though the NASDAQ, the tech-heavy NASDAQ composite, fell very sharply in the latter 9 months of 2000, of the year 2000, the S&P 500 kind of hung out around that 1500 level all the way up until September, October of 2000, when it began to definitively break lower. And you can kind of see that on the far left-hand side of this weekly candle chart of the S&P 500. You'll notice in particular how the S&P 500 broke below its 40-week moving average. Now that yellow line you see on the chart is the 40-week moving average. Why do I look at the 40-week moving average? I have found that the 40-week moving average, which is approximately the same thing as a 200-day moving average, because there are 5 trading days a week, you multiply 5 by 40, you get 200. So it's roughly the same as the 200-day moving average for the S&P 500. I found that to be a good long-term trend indicator. Specifically, when a stock or index is trading below a falling 40-week moving average, that's a really good sign that that market or that index or that stock is in a bear market. So if it's trading below a falling 40-week moving average, if it's trading above a rising 40-week moving average, that's a good sign of a bull market. So obviously there are all kinds of different definitions of a bull market and a bear market. Technical analysis, looking at charts, some people think it's very useful, others find it much less so. I use it. I use fundamentals, of course, as well in deep dive investing. I use it to help point me towards stocks or indices that I might want to buy, and I use it as a warning sign for stocks or indices that may be breaking down. In this case, though, over the long term, I think a 40-week moving average gives you a pretty good idea of where the bull and the bear cycles are on this chart. Obviously, the left-hand side of this chart, up the very left 1/3 or so of this chart from 2000 until 2003, the S&P 500 was below a falling 40-week moving average until the first half of 2003. That's a bear market. Bull market kind of kicked off from early 2003 up to mid 2003, lasted all the way up until the end of 2007. Throughout this period, the S&P 500 was above a rising 40-week moving average. Of course, there were a couple instances like late 2004 and again in mid 2006 and a couple others where the S&P 500 touched or pulled back and tested its 40-week moving average. However, the 40-week moving average continued to be rising itself, and the S&P 500 never broke that far below its 40-week moving average. That's still pretty characteristic of a bull market. You will see tests of that level. Rarely are you going to see it actually roll over and begin falling, which would be a bear market. And then, of course, towards the very right-hand side of this chart, you can see that the 40-week moving average was once again falling, and the S&P 500 is trading below a falling 40-week moving average. Classic definition of a new bear market there in late 2007. So let's flip from the stock market. You can kind of see what happened to the stock market over this time period. Let's flip over to the economy. Now, this is a chart of the month-over-month change in the U.S. leading economic index. Those of you who are unfamiliar with the U.S. leading economic index, you're probably pretty new subscribers to Deep Dive Investing because it's something we've covered a lot in this service going back from the very beginning. You'll also find a pretty detailed primer, if you will, on U.S. LEI, the Conference Board's leading economic index, in late December of last year, so late December 2017. There's a really good primer, another issue just like this you can check out, where I explain it, how it works, and how we use it. Generally speaking, though, we found it to be a very good indicator of the health of the U.S. economy. This is a month-over-month change. When you see a string of negative readings, so readings under that zero line, that's indicative of a weakening or weak economy. The more groupings of really negative numbers you see, the more likely it is the economy is in recession. Positive readings are a good sign of a strengthening or booming economy. So it gives you a really good feel. And I've put this chart over roughly the same time frame as the prior chart of the S&P 500 itself. Over this time period, technically the U.S. entered recession in March of 2001. And it exited recession in November of 2001. Why do I say technically? Most people use the business cycle dates put forward by the National Bureau of Economic Research Business Cycle Dating Committee. Obviously, you might have heard that a recession is 2 consecutive quarters of negative GDP growth. That's actually not true. The NBER definition includes a lot more indicators than just the growth in the overall economy. They look at all different levels of the economy, housing market, stock market, credit market conditions, etc. And what they're looking for, generally speaking, the general guideline is kind of persistent weakness in the U.S. economy. Persistent weakness in the U.S. economy. Significant persistent weakness, and that's when they call a recession starting or recession ending. You can also see it on LEI. Typically, you'll see a clustering of negative readings ahead of the start of a recession, and you'll see a clustering of positive readings just as or right before the U.S. economy exits recession. And you can definitely see that on this chart here. We were in a comparatively rare situation in that cycle from 2000 all the way up until 2007, where the stock market actually topped out in March of 2000, but the U.S. didn't enter a recession until a year later. That's very unusual. Usually the U.S. stock market peaks out just a few months before the U.S. economy enters recession. Typically also, the U.S. stock market will bottom out a little bit before the economy begins to recover. So the stock market typically leads the economy. It tops out before the economy enters recession, and it bottoms out before the U.S. economy officially exits recession. This cycle, though, this early 2000 cycle was a little unusual because the stock market peaked out long before the US economy entered recession, 12 months before, unusually long lead time. It also bottomed out after the US economy exited recession. So the US economy exited recession technically in November of 2001. The stock market didn't bottom out until October of 2002. So that's kind of a rare situation. But let's look at LEI, and I think you can kind of see what was going on here. Why was it rare, by the way? The most likely explanation is that most of the market weakness was led by the collapse of a bubble in technology stocks that started in the late 1990s. And so tech was kind of pushing the overall stock market lower. We actually saw a lot of groups, including small companies, actually begin to perform pretty well long before the S&P 500 bottomed out. So I would say it's not so much that it was an unusual cycle because the stock market took a long time after the recession ended to actually bottom out. It was actually that most stocks actually did bottom out right around the time the U.S. economy exited recession in late 2001, even though the broader market didn't because of the headwind of technology being in a really nasty bear market. What you should note, though, here on this chart of LEI is that LEI was actually started to get weak in 2000. Right here at the beginning of the chart, you can definitely see that there. In early 2000, we saw a clustering of negative readings. Through the middle of 2000, a lot of negative readings. And by the end of the year 2000, we were seeing very negative readings of negative 0.5 and higher month over month. So LEI did a good job of signaling that recession starting in early 2001. LEI remained very negative going into early 2001. It saw a little bit of a recovery right at the end of 2001 and early 2002, but then it kind of weakened again in late 2002. So what we had was a pretty mild recession in 2001 and a pretty weak recovery in early 2002, and then kind of a period of stagnancy. We really didn't see the economy pick up in earnest until the second half of 2003. And if I flip back to this prior chart, you'll see that actually corresponds pretty well to the market cycle here. You can see that even though the stock market technically bottomed out in October 2002, it really didn't start rising again in earnest. We saw a lot of chopping around from the middle of 2002 all the way up until the first half of 2003. It didn't really start to take off higher until the middle of 2003, which corresponds to when LEI started to get really positive, as you can see on this chart. So even though if you look at the actual bottom for the stock market, it looked like it bottomed out long after the recovery started. If you look at LEI, you can kind of see what was happening there. The economy didn't really begin a robust recovery until the middle of 2003, and that's about when the stock market really took off. So it actually corresponds pretty well. And again, it corresponds to that market bottom, which kind of happened gradually between late 2000, the second half of 2002 and the first half of 2003. As I said, a little unusual because of the influence of the boom and bust in technology stocks, which made up about a third of the S&P 500 at one point in 2000. So just a really big headwind for the overall market. We move from that recession and the bottoming out to the coming bull market and economic expansion. So middle of 2003, the economy really expanded all the way up through 2004. We saw the LEI begin to weaken, as you can see on this chart, in early 2006. And then you can definitely see a clustering of negative readings starting in mid-2007. The U.S. economy technically entered a recession in December of 2007. The stock market peaked out in October of 2007. So this was in some ways a more normal cycle. We saw this long bull market in the stock market, as you can see on this chart. The stock market peaked out a few months before the U.S. economy entered recession in late 2007. You can definitely see the weakness in LEI towards the end of 2006 and the first half of 2007, signaling that recession, and then the very weak readings in LEI towards the end of 2007 and early 2008, indicating a recession and also the beginning of a bear market for the stock market, as I showed you on that prior chart. All right, so we divide the market and economic cycle up into 4 distinct stages or phases. There's the recessionary bear market, where the US economy is contracting, the S&P 500 is in a bear market. You have the early stage, where you're starting to see some green shoots for the economy. You're starting to see LEI turn just positive and beginning to show a few months in a row perhaps, or a few months out of the last 6 months of showing positive readings, or even just becoming a little bit less negative than during the recession. And the stock market's typically at this stage has bottomed out and is in the early stages of a rally, or is just breaking above that 40-week moving average that I showed you. Or in some cases, like in 2002, 2003, it's kind of showing a lot of volatility but not making a lot of progress on the downside. In the early stages, the early cycle recovery, you often see the economy really boom because it's kind of snapping back from contraction from the recession. In the mid-cycle, you kind of have the U.S. economy humming along. LEI is typically going to be mainly positive, maybe a few negative readings interspersed in there. Sometimes you'll have, though we don't consider it a separate stage, and I will talk about it a little bit more later on, you'll have what's often called a soft patch for the economy. That's where economic growth really slows down. Sometimes it stalls out, and you'll even see a quarter of negative growth, such as we've seen over the last few years at times. But it's not persistent or large enough of an economic weakness to be classified as a recession. You can actually see some really nasty corrections for the stock market to that 40-week moving average or a little bit below. During these soft patches, in fact, you often do, like we saw nearly 20% pullback, nearly meeting the definition of a bear market back in late 2015, early 2016, even though the economy didn't technically enter a full-blown recession. But generally in the mid-cycle, you're going to see growth, near-trend growth for the economy, and you're going to see the stock market in a solid bull market phase. Then we have the late cycle of this entire economic and market cycle. At this stage, you'll typically see LEI begin to weaken, the US economy begin to slow down, and I'll talk about some of the other factors you typically see at this stage of the cycle a little later on, but some of them that we've talked about a little bit in the past. You'll often see, at this stage of the cycle, you'll see a flat yield curve. So the difference between 2-year government bond yields and 10-year government bond yields is low, and that's typically because the Federal Reserve has been boosting interest rates, and so that's pushing up short-term rates, and then long-term rates aren't moving up as fast or as far because the market expects the economy to weaken and inflation to come down. You'll also typically see, so typically in the late cycle, the Fed is hiking rates or has been through a hiking cycle. And typically you'll see the economy beginning to slow down, and you'll see often inflation picking up at this stage of the cycle. Then eventually you transition from so on this chart, the late cycle would be 2006 and 2007. You can clearly see, for example, here that LEI had a lot of clustering of negative readings. Not huge negative readings, usually under negative 0.5, but definitely a clustering of negative readings there. And that was right before the U.S. economy entered recession in December 2007. And then, of course, you re-enter that stage I talked about earlier, the recessionary bear market, which in this case happened in 2007 on through 2009. So different stocks and groups, different characteristics in a stock tend to work at different stages of the cycle. Now, I'm going to apologize for this table because it's kind of complicated when you look at it on your screen. Please do follow along in the accompanying PDF of my slide presentation if you want a little bit more detail. And I know it looks complicated at first, but let me explain it. I took this cycle that I just showed you in the stock market here and in the US economy here, and I divided it up into those different stages of the cycle that I mentioned to you. The first phase of the cycle I looked at was from the end of September 2002 up until the middle of 2004. I'm defining this as the early cycle of the recovery. As I said, that's when we began to see improvement in LEI, and the stock market bottomed out, and then finally in early 2003 actually broke above its 40-week moving average, and we saw very strong growth in LEI. I'm defining the period from mid-2004. So these cycles aren't exact science. It's not arbitrary, but it's not an exact science. I'm just looking for characteristics that typically define these various cycles. Mid-2004 through early 2006, I'm defining that as mid-cycle. Pretty steady at-trend growth for the overall U.S. economy. Stock market was in a solid uptrend. There were corrections, there were little soft patches, but pretty much on trend. Late cycle I'm defining as the end of March 2006 through the end of September 2007. So June 2004 through the end of March 2006, mid-cycle. End of March 2006 through end of September 2007, late cycle. Market actually peaked out in October 2007. Definitely saw a weakening in LEI in 2006 and 2007. Economy didn't enter recession until December that year. That's the late cycle. Then we have the first part of the bear market, the first few months of the bear market from late 2007 until June 2008. And then the second part of the bear market from June of 2008 until early 2009. So those last two columns actually only represent one stage of the market and economic cycle. It's the recessionary bear market stage. However, I broke it up because the stock market came down quite a bit. I think it was down around 14% in the first, between its highs and late June of 2008. But it didn't really collapse and fall really sharply until between late June of 2008 and early 2009. So I kind of broke up that last stage of the cycle to kind of make the trends more clear, if you will. So if we look at these different rows, okay, these are actually what are known as factor portfolios that Bloomberg puts together. And they're based on characteristics in stocks that we've talked about a lot in deep dive investing in the past. We've talked about momentum, growth, value, quality, etc. They just define them using a very particular set of characteristics. So I'm going to go through each one of these to tell you what they are. The one that's labeled US Pure Momentum, very simple. These are stocks that are going up faster than average. Okay, so these are stocks that technically over the past year are outperforming the market, are performing, and they look at a group of 3,000 stocks, 3,000 US companies. So these are companies that are performing well. The stock price, the total return in the stock, including dividends, is doing well. Pure growth, these are companies that show strong earnings and sales growth. These are going to be typically your secular growth companies. They'd be companies that are involved in, right now, industries like technology are a classic example. They're showing strong and consistent earnings growth. They're not cyclical companies. Value companies, the bottom row on this chart, is kind of the opposite of growth. These are companies that have low valuations in terms of price to earnings, price to sales, price to free cash flow, all kinds of different valuation metrics. So if we go back to the third row here, the US Pure Trading Action Portfolio, or Trading Activity Portfolio. These are stocks that have a lot of volume, that are seeing a lot of trading activity. They're heavily traded, very liquid companies. The next one there, the Pure Volatility Portfolio. Basically, this is another word for beta. These are companies that show a lot of stock price volatility. They move a lot. It's typically known as a measure of quality and risk. Stocks that are very risky move a lot and would rank high on this volatility portfolio. We have the Pure Dividend Yield Portfolio. These are stocks that have a high indicated dividend yield. The Pure Leverage Portfolio, these are companies that have a lot of debt, high debt to equity ratios. Pure Size Portfolio, companies that rank high on this characteristic are big companies, large caps. Companies, small caps would rank near the bottom on this characteristic, right? Pure profit portfolio. These are companies that show consistent profitability, profit margins, return on equity, return on assets. The pure earnings portfolio refers to earnings volatility. So volatility in their profitability. So stocks that rank high on this metric actually have a lot of earnings volatility. So they tend to be riskier, lower quality companies. What these numbers represent is the return of the companies that rank highest on each one of these characteristics, the quintile, the top 20% of these 3,000 US companies that rank high on each one of these characteristics I just outlined, less the performance of the companies that rank in quintile 5, so lowest on that particular characteristic. So for example, if companies that rank high on momentum, so are showing a lot of stock price momentum, perform better than companies that have not a lot of stock price momentum, in other words, that haven't been performing well over the past year, then that first row will be a positive number. So if momentum is working, if buying stocks that have done well over the past year leads to picking companies that are outperforming the market going forward, right? Then that number will be positive, okay? If the opposite is true, if companies that have been performing well tend to start performing poorly, and portfolios of companies that have been performing poorly start to perform well, then you're going to see a negative number on that momentum. So basically, it's just a way of dividing up the entire universe of companies based on certain fundamental or technical characteristics and determining how portfolios based on that characteristic are working. Now, the key thing here is that at different stages of the economic cycle, different stock characteristics tend to work. So let's start with the early cycle. And in this case, I'm looking at the period from September 2002 all the way up through June 2004. So look at that first column on this table. I've bold-faced large negative numbers and large positive numbers. So if the absolute value of the number is relatively large, I've bold-faced it. And for large positive numbers, I've highlighted it in green. For large negative numbers, I've highlighted it in red. So what characteristics work in the early stage of a market and economic cycle? What characteristics work? Well, the US pure trading activity portfolio during this early cycle from 2002 to 2004 did really well. The pure volatility portfolio also did very well. Those two are related. Companies that have a lot of volume, unusually large amounts of volume, big spikes in volume, and companies that have a lot of price volatility, these tend to be kind of lower quality, riskier companies, riskier stocks. There's an old adage in the stock market that the trash always floats to the surface first in the early stages of a bull market. In other words, low quality, very volatile companies tend to rise fastest early in a bull market. A lot of times this is because some of these companies are kind of fallen angels. So they might be companies that have been absolutely slaughtered during the bear market. Some of them may have been at risk of going into bankruptcy. And then when the economy starts recovering, credit markets open back up again. These companies can go from being, penny stocks or under $5 a share. They can double, triple, quadruple in a short period of time as the economy recovers and credit market conditions improve. We saw that a lot, for example, with energy companies back in early 2009. Energy prices came down sharply in the second half of 2008 and early 2009. I can remember a lot of energy producers trading $2 a share. By that summer or fall, they were trading 5 times that price because credit markets had reopened and they were survived. So the stocks went up a lot. Also, it makes sense if you consider that companies with a lot of price volatility, meaning that they tend to move faster than the S&P 500. So a company with a high beta, for example, tends to move faster than the S&P 500 in the early stages of a market rally. When the stock market's just rallying off a low, the returns tend to be very high for the overall stock market. So obviously companies that show a lot of price volatility and tend to move faster than the stock market are going to do well in that kind of an environment. Companies with a ton of leverage do well, that pure leverage portfolio. Why? Again, as I said, if a company has a lot of debt during a recession, that can be a huge problem. Banks aren't lending, bondholders want high yields for junk companies or for low quality companies with a lot of debt. When the credit markets reopen in the early cycle, when investors start buying junk bonds again, when banks starting to loosen the spigots on lending, they can go from being at risk of bankruptcy to being okay very quickly, and therefore those stocks tend to perform well in the early stages of a bull market. Pure earnings portfolio, again, that refers to earnings volatility. Companies that rank high on this measure are low quality companies. They don't have consistent profitability over time. Again, they tend to perform very, very well in the early stages of a bull market, as you can see from this time period highlighted in green. Finally, the pure value portfolio, I will tell you that this cycle from 2002 to 2007 was a little unusual. Value consistently outperformed the rest of the market over this time period, partly because those were the companies that didn't get, in other words, a lot of the growth companies were in the NASDAQ and got caught up in the bear market from 2000 up until 2003. And those busted bubble companies took a little longer to recover. So value stocks tended to perform better than growth throughout much of this time period, throughout much of this bull market. And there are different definitions of value. So I'm going to go ahead and just put a pin in that row, if you will, and we'll discuss that separately later, because the value growth dynamic, whether value stocks are outperforming growth or growth are outperforming value, is one of the most talked about features in any stock market cycle. So I want to talk about that. That deserves its own time. So we'll talk about that a little later on. So let's move from the stocks that perform well in the early cycle to stocks that perform poorly. Momentum does not perform well in the early cycle. Why is that? Well, because by definition, there's a lot of reversals in the early cycle of a bull market. Companies that were in a downtrend during the bear market are reversing into an uptrend because the overall market's reversing into an uptrend. Stocks that tended to do well during the bear market years are, for example, super high quality companies, consumer staples, that kind of stock. They tend to underperform when the market's rallying. So because there are a lot of reversals, momentum, buying what works and selling what buying what has been working and selling what hasn't been working does not work well in the early cycle. What else doesn't work well? Large companies underperform small companies. So you can see that pure size portfolio, larger capitalization companies tend to underperform small cap companies in the early stages of a bull market. Also, high quality companies with consistent profitability and high ROE. I know this might sound a little bit counterintuitive, but high quality does not perform well in the early stages of a bull market. The reason is, right, as I said, trash floats to the surface fastest. You typically see your low quality companies bounce back the fastest when the stock market begins to recover. The super high quality companies that the investors tend to hide in during a bear market because they want consistent profitability during a bear market, they tend to do poorly as the economy does recover. So let's move from the early cycle to the mid-cycle. What works in the mid-cycle years? Momentum really starts to work in the middle of an economic cycle. Momentum. So in other words, buying stocks that have done well over the past year and selling stocks that have not done well over the past year, or buying stocks that perform better than average and selling stocks that perform worse than average, tends to work well in the middle of the cycle. What works keeps working. What doesn't work keeps not working. Volatility still works okay in this time period. Because the stock market's typically in a bull market, in a steady uptrend at this phase, stocks that move faster than the broader market tend to outperform the broader market. Makes sense. Dividend yields often don't perform well in this time period, but there's a lot of variation there. The reason typically is, and in this case it's certainly the case, between 2004 and 2006, the Federal Reserve was aggressively boosting interest rates. And as we've both talked about, myself and Roger Conrad have talked about, not all dividend-paying stocks perform poorly when the Fed's hiking interest rates, but companies that have a high yield but no growth in that yield do tend to underperform the broader stock market. And that's what this is picking up here. Large companies also tend to slightly underperform small companies during this strong phase of the bull market. That is typically that's kind of to be expected because the stock market's doing well over this time period, and small companies tend to move faster than large companies. And so let's move from the mid-cycle to, as I said, we'll get back to the value versus growth thing a little later on. But at this phase of the cycle, it is fair to say value usually outperforms growth, and it did at this time period. And that's typically because value stocks are more cyclical than growth stocks. They're more leveraged to the state of the economy. When the economy is growing well, they tend to outperform. When the economy starts to do poorly, they tend to historically perform worse. Value tends to underperform growth. Let's move to the late cycle here. That's from March of 2006 through September of 2007. Momentum keeps working in the late cycle. Growth stocks tend to outperform value a little bit in the late cycle. That's typically because, as I said earlier, you're starting to see the economy weaken, LEI weaken, and again, value stocks tend to be more cyclical than growth stocks. Trading action, stocks with a lot of trading activity tend to start to underperform at this stage. Stocks with a lot of leverage tend to underperform at this stage. So stocks with an awful lot of debt start to really underperform as we move into the late cycle. And if you look to your right there in the fourth and fifth columns, you'll see that heavily indebted companies really start to underperform as the bear market gets started. So you really want to avoid companies with a lot of debt in the late cycle bull market and in the early stages of the bear market and in the late stages of the bear market. Those companies, heavily indebted companies, only outperform very early in the cycle. Large companies do tend to begin to outperform small companies as we reach the latter stages of a market rally and an economic expansion. If you think about it, it's another way of talking about market breadth, which we've talked about a lot over the last several years. Typically, even though the stock market continues to rally to new highs, you'll begin to see most stocks top out before you reach an ultimate top for the bull market. So for example, in 2007, the stock market reached a peak in October 2007. Most stocks had peaked out by June of 2007. So a lot of small cap companies were already in a bear market, even though the S&P 500 made a marginal new high in October. So large companies, more stable companies tend to outperform small caps as we enter the latter stages of a bull market. Companies with strong profitability metrics, return on equity, return on assets, net profit margin, quality stocks, also start to perform better in the latter stages of an economic and market expansion. We've talked about this a lot before, actually. Earlier this year, we did an issue in March, I believe, on quality companies, so companies that ranked highly on profitability metrics like return on equity. They tend to do better as market volatility picks up. Stock market volatility usually picks up in the final 12 to 18 months of a bull market, and therefore high quality stocks start to outperform low quality stocks and the broader market as we enter the latter stages of a bull market. Now let's look at the last two columns just quickly. Interestingly, I found this very interesting. Momentum companies, stocks that have been doing well, tend to continue to do well early in the stages of a bear market. So momentum continues to work in the early stages of some bear markets, and in this case, the 2002 to 2007, 2008 bull market phase. Momentum actually worked. Partly this is because stocks that start breaking down really fall faster than the broader market. So momentum does work on both the upside and downside early in a bear market. Profitability Quality, again, US pure profit portfolio, that also works very well in the early stages of a bear market. So one thing this tells me is that, as I've said before, quality is actually a really good bridge. When you think the stock market may be nearing a top, it's a good time to pick up high quality companies, companies with consistent profitability and larger companies, because they do tend to outperform the broader stock market, both in the latter stages of a bull market and in the early stages of a bear market. So it's a great kind of company to own as you move through the top in the stock market. You'll outperform the broader stock market if you own high quality stocks. Companies with a lot of earnings volatility, wow, they really start to perform badly at this stage of the cycle. Heavily leveraged companies, as I mentioned, perform poorly at this stage of this stage of the cycle, and that's again because low quality companies are the ones that get hurt first and worst in a bear market. And we move to the latter stages of this nasty, vicious bear market from 2007 to 2009. You'll see that growth underperformed in that cycle. Value started to perform better as we entered the latter stages of that bear market. That's actually normal. Value often turns before growth at the end of a bear market. Volatile stocks, heavily leveraged stocks performed worst, and again, high quality stocks performed best. Now, note that this doesn't necessarily mean that those high quality stocks were up. In fact, in 2007 and 2009, something like 85 to 90% of all companies in the in the U.S. stock market fell over that time period considerably. But it does mean they're probably outperforming the broader market. So again, owning quality towards the end of a bull market and the early stages of bear market is a very good thing. What you want to avoid or even look to short are companies with a lot of debt, as you can see there, and low quality companies with a lot of earnings volatility. So that's a pretty good general indicator of what happened during this long market phase between 2002 and 2009. This is the beginning, a whole bull market cycle and a whole bear market cycle. And I'm going to also take a look with a little bit more depth at what's happened in the bull market since 2009 here on the next slide. Okay, so let's move from the 2002 to 2008 cycle over to the current bull market, which started in early 2009, in March of 2009. And this is just a chart of the S&P 500, again, a weekly chart of the S&P 500. You will note that, of course, this bull market is significantly longer than the 2002 to 2007 bull market. This bull market, again, started in 2009, so it's 9 years old, so it's already almost twice as long as the last bull market in the S&P. But the same basic pattern persists here. You can see that on the far left-hand side of the chart, again, we have the 40-week moving average in yellow. We have the chart of the S&P 500. It's trading below a falling 40-week moving average. Pretty classic definition of a downtrend or a bear market. By around the middle of 2009, a couple months after the bottom, the S&P 500 broke below that 40-week moving average. And by and large, it has been above a rising 40-week moving average for most of this bull market. Now, there are some exceptions, which you'll see here on the chart. It dipped below that level pretty meaningfully in 2011, and in fact the 40-week moving average was kind of falling a bit there towards the second half of 2011, early 2012. Then we saw it again in 2015, 2016. And what's interesting about both these occasions, and I'll show you what it looked like for the economy here in just a minute, but we almost saw a bear market, a technical bear market in 2015, 2016. From closing high to closing low, the S&P 500 was down over 19%, and the technical definition of a bear market is usually taken to be a close, in other words, a sell-off from a closing high to a closing low of 20% or more. So we're kind of dealing with a minor distinction, which probably isn't very meaningful. And I'll show you here in a minute how both those 2011, 2012, and 2015, 2016 pullbacks, severe pullbacks in the S&P 500 corresponded to some soft patches for the economy. But broadly speaking, it's hard to claim that from mid 2009 up until the present day, this stock market hasn't been in an uptrend in a bull market. And that's certainly been true very recently, since the middle of 2016 or so, when the S&P 500 broke above that 40-week moving average, and it's been in a very steady uptrend. A lot of people say, well, there was a nasty pullback back in February, March of this year, and that's true. Right? We did have a more than 10% pullback from high to low in the S&P 500, but keep in mind that on average, since 1937, there's been one pullback of 10% or more per year in the S&P 500. So not really at all unusual. And as you can see from this chart, that pullback basically stopped again at that 40-week moving average, the 200-day moving average, if you prefer to look at a daily chart. And since then, we're off to the races again, new highs on the S&P 500. This is still a bull market. Let's look at the economy over this time period. Clearly, you can see the very negative readings on the leading economic index back in early 2009. This chart goes from December 2008 all the way up through the present. And you can see those very negative readings in late 2008, early 2009. US was still in a recession. We did start to see some green shoots, if you will, back in the spring of 2009. In the form of a series of consecutive positive readings on the leading economic index. And in fact, the NBER, the National Bureau of Economic Research Business Cycle Dating Committee, says that the U.S. economy exited recession in June 2009. And of course, the low for the stock market was March of 2009, a few months ahead of the economy. As I said, that's normal. You can also see a nice grouping of pretty positive readings for LEI in the second half of 2009 and really into 2010. And really actually into the first half or so of 2011. So we saw the normal snapback from recession. I will say, and this is something I brought up before in deep dive investing, that there's an old rule of thumb in economics that the worse the recession, the bigger the snapback. The economy is kind of like if you will, a rubber band. And so when growth is well above trend for a long period of time, you start to see excesses build up, right? So you see inflation, you see wage price spirals, you see bubbles in different markets like housing back in 2007 and 2009. That's when the economy is growing kind of faster than trend. And therefore, you're going to tend to get the correction from that. It's ultimately going to be a recession, where the economy is going to grow below trend a little bit to kind of even it out over time. And the same is true on the downside, right? When the economy is plummeting, just a severe recession like we saw in 2008, 2009, and back in the early 70s as well, you'll typically see very strong economic growth coming out of that as the credit spigots reopen, as consumers go from being in sort of damage limitation, debt pay down mode to wanting to spend again. The employment market goes from rising unemployment and lack of jobs to a better jobs market, which makes people feel more confident. All those things tend to snap back, and you see at least a few quarters of very strong economic growth. I will say, though, that was not really the case with this last downturn. The recovery from the 2007 to 2009 Great Recession, as it's being called, and financial crisis is actually the worst recovery from any recession in U.S. economic history going back to the 1930s. So it's been a very slow recovery. We did see, as you can see from this chart, some pretty positive LEI readings in late 2009, early 2010. Note in particular, kind of that clustering of readings around plus 1% month over month. That's very strong. But it's still been a lackluster economic period overall. Technically, the National Bureau of Economic Research says we have not seen a recession since 2009, when the last one ended in the middle of 2009. However, as you can see here, we did have some notable soft patches. You'll notice the one there in 2011, 2012. Notice a clustering of negative LEI readings. And again, in 2015, 2016, note how in the middle of 2015, from the middle of 2015 all the way up through the middle of 2016, we saw more negative readings on LEI than positive readings. And that corresponded to that big sell-off I showed you on the prior chart. I'd also note that since the middle of 2016, and certainly in 2017 and 2018, LEI has been pretty consistently positive. We actually haven't had a negative reading on LEI since 2016, so it's been 2 years plus. So it would be unprecedented, really, for there to be a recession over the next 6 to 12 months with LEI as strong as it is today. Not saying it's impossible. We have seen, it'd be almost unprecedented, I guess I should say. It's not impossible. We have seen the economy turn very quickly in response to shocks, such as in the early 70s, the oil price crisis, where oil prices quadrupled in a matter of months. But it's rare. And typically, you would see a forewarner of that in the form of a grouping of negative LEI readings before we get to the end of the rally, end of the bull market. So that's a picture for the economy. And I just want to point out, in summation, those two soft patches in 2011, 2012, and again in 2015, 2016. So let's look at the same chart that we looked at before with these different fundamental factors and technical factors on the left, same ones I showed you before, and all these different time periods that I've created here. The far left-hand column you see there, the first column of numbers, is the early cycle. So that's from the first 2 years, basically, of the market rally. Technically the market bottomed in early March, but I'm using monthly data here to make it easier to see. So we're looking at the first 2 years of the market rally. Again, just as I showed you before, momentum, a prominent underperformer. Momentum does not work in the early cycle. Volatility, stock volatility, trading activity, very strong positive readings. Again, riskiest stocks, most widely traded stocks, and most volatile stocks tend to recover fastest in the early stages of a new cycle. Highly leveraged companies, again, just like the last cycle, performed very well in the early part of the cycle. Again, and this was actually magnified in this cycle because it was such a severe credit crisis in 28, 29, early 2008 into early 2009. The funding markets were shut off even for some big investment grade companies. So not a lot of bank credit. Investors were not buying high yield bonds. So leveraged companies were in serious trouble in early 2009 when the economy began to improve and the credit markets started kind of functioning again. In late 2008, early 2009, we saw those stocks bounce back writ large, and that's what you're seeing there. Large companies underperformed. That's the pure size portfolio. And high quality companies, the pure profitability portfolio, they all underperformed. Again, quality and large cap tend to underperform in the early stages of a recovery. Small cap stocks are where the best action is. Value also performed very well in the early stages of the recovery. I talked about value in a separate section a little while earlier, but there is a strong tendency historically for value to do well, regardless of how you measure it, in the early stages of a stock market recovery. So what's the next column there, that second column from February 2011 to the end of 2012? Okay, that's the soft patch. That's kind of the first soft patch. I would say that the U.S. economy was in the mid-cycle of the recovery at that time. Growth had slowed down from that initial burst. So we were kind of in a mid-cycle phase, but there was definitely a soft patch at that time. And so I wanted to break it out so you can kind of see what happens in one of those nasty corrections that don't quite qualify as a bear market, but have almost all the same hallmarks of a bear market, including a big drop in the stock market. And you can see, it's kind of what you would expect. High quality performs well. Pure profit portfolio performed well. Your volatile stocks did not do well. They underperformed. Interestingly, though, during those soft patches, momentum actually did perform quite well in that first soft patch. Okay, so let's move to this next phase from the end of 2012 up through the middle of 2015. This was a period of an acceleration in the U.S. economy coming out of that soft patch. If you remember the news flow back then, that was the beginning of kind of the European credit crisis. By early 2011, in that second column there, we were already seeing the start of a major credit crisis that had spread beyond a few smaller countries to some of the bigger countries in Europe like Italy. And we also saw in 2012 the US debt downgrade, which was quite an event. By the end of 2012, though, until the middle of 2015, we were kind of back on risk-on mode. The US economy had started to bounce back. Even the European economies had started to bounce back. Credit markets were loosening up again. And though there were still some problems in Europe, the big countries were at least off the headlines, like Italy. And as you can see here, momentum did really well in that time period, that period of acceleration. I like to think of the economy as, when we say it grows at trend, that doesn't mean that it grows by the same amount every single quarter. There's going to be periods of above trend growth and periods of slightly below trend growth. But the average during this mid-cycle is going to be around kind of that trend rate, sort of middling rate. So we saw a little bit of a slowdown, the soft patch in 2011, 2012, and then the reacceleration from 2012 through middle of 2015. Value did very well on the bottom there. That's typically because value stocks tend to be more cyclical groups like energy, and they tend to do better in markets where you're having an economic acceleration. The pure profitable portfolio did poorly. The reason being high quality tends to lag the market when the market's rising very rapidly. And you have growth also did pretty well actually during this period, but not as well as value. So value did outperform growth. Moving along to the next phase here, another soft patch from the middle of 2015 to the middle of 2016. Once again, what did we see? Volatile stocks, stocks with a lot of trading activity, stocks with a lot of leverage, all underperformed very to a great degree during this time period. Value underperformed because the economy was so weak. And we do see here that earnings volatility, that US pure earnings portfolio, also underperformed. Low quality underperformed. The pure profit portfolio, again, the high quality, outperformed. Moving again from the middle of 2016 up to the present time, again, a period of strengthening growth again. And again, what do we see? Momentum worked again. Volatility and trading activity worked again. We did see earnings volatility work, that pure earnings volatility portfolio. Value, interestingly, did not work during this period, something I'll talk about a little later on. And we've actually seen leverage really not work over this period. So stocks with a lot of leverage have been underperforming the market ever since the middle of 2016, even though a lot of the other factors are risk-on type factors. Investors are shunning highly leveraged companies. I think that's partly because rising interest rates, concerns about quantitative tightening, the reversal of the Fed's ultra easy money policies. But this is definitely something to keep an eye on. And in fact, we think highly leveraged stocks will probably continue to outperform. They typically do, as we showed you earlier, in the latter stages of a cycle. I broke out even a little, to give you a little more granularity, I did break out even further. And I looked at the period from February 28th, 2011, all the way up through the end of January of 2018. Why did I choose that time frame? That's the beginning of the mid-cycle of this recovery, all the way up until we had this most recent correction in the stock market. And you can see throughout that long period, that 7-year period there, momentum has been a big winner this whole time. Leverage has been a big loser, and value on this basis has been a big winner. I keep hearing people say that values underperformed growth for many years in a row. And again, I'd point you back to that slide I mentioned a little while ago. It really depends upon how you measure value. On this basis, the Bloomberg factor studies, using all those different metrics I showed you earlier, value has actually outperformed growth by a wide margin. And then I want to show you that last little nub period, which is really this year, just from the end of January up through the present time. Stock market's seen a big correction and subsequently a recovery to new all-time highs. What's working now? Momentum. You've got the high quality has begun to show some signs of improvement, but value has underperformed this year since that correction in late January. So that gives you an idea of some of these factors and how they've worked. And if you look at this chart and compare it to the prior chart I showed you from the last rally, you'll find a lot of overlap there. You'll find a lot of the same factors worked at different stages of the cycle. So again, I can't stress it enough. This is not a roadmap. It's not a deterministic thing. It doesn't always work so neatly. However, there is a strong tendency for stocks with certain characteristics to perform better at different stages of the economic cycle. The value growth equation, something that I want to now get into a little bit more granularity on. We talked about it a little bit earlier, but I want to give you some specifics here. This is what most people look at when they look at the value growth equation. This is the Russell 1000 index. The Russell 1000 index is an index of 1,000 roughly U.S. large cap stocks. You could also look at the S&P 500, which is 500 very large companies. And the Russell 1000 index is divided up into a Russell 1000 growth index and a Russell 1000 value index. So most people, when they say value is outperforming growth or growth is outperforming value, they're basically just looking at the performance of the Russell 1000 growth index versus the performance of the Russell 1000 value index, or the S&P 500 growth index versus the S&P 500 value index. I'm going to look at the Russell here because it's a broader index. It's still a large cap index, but it's a broader one. And I'm looking at the period from 1997 till the present time. And all I've done, this is weekly data, I'm dividing the price of the Russell growth index by the Russell value index. When this line is rising, the Russell growth is outperforming value. When it's falling, value is outperforming growth. And you can see here that from the end of 2016, early 2017, growth has been consistently outperforming value on this basis. If we look back in history, in fact, growth has largely been outperforming value on this basis since the end of 2006, so a very long period of time. You can see in going even farther back in history, you can see how the late 1990s were a period where growth outperformed value. The early 2000s were a period when growth underperformed value, when value outperformed growth. Of course, growth outperformed value in the late 90s. That was a tech bubble. And then value snapped back in the early 2000s. So that's what most people are talking about when they mention that growth outperformed value or vice versa. There are many other ways to look at value. Here's another one. Here's one that we talked about a few slides ago, and that's that Bloomberg Pure Value Index, the Bloomberg Pure Momentum Index, and the Bloomberg Pure Growth Index. Those are the three lines on this chart. And as you can see, since 2000, so I took this data back on a total return basis to 2000, value has outperformed both of those other factor indices by a huge margin. And remember, this is not a true index, right? These factor portfolios are a quintile portfolio. So what it is, it's a long-short portfolio. Bloomberg's saying, what would your return have been if you bought the 1/20th, the top 20%, 1/5, the top 20% of stocks ranked by low valuations, and you sold short the 20% of stocks with the highest valuations. What would your return have been? Obviously, the market's generally been rising over this time period. So having a long-short portfolio is not going to make as much money as being purely long over most of this time frame. But what it does tell you is if a particular characteristic has an influence on stock market returns in a given time period. And you can see that the Pure Value Index up 135% on that basis just blew the other two indices. Momentum's only up 4.6%. And growth is down over this time period. So value on this basis has worked. On this prior basis, there's been cycles. Growth works, then value works. It's all about how you define value or growth. I showed you the most common one, simply looking at the performance of the S&P or the Russell 1000 value index versus the Russell growth or the S&P 500 value. As I said, pure value, the Bloomberg one that I just showed you, is a long-short portfolio. Russell indices and the S&P 500 are traditional indices weighted by market capitalization. The Russell 1000 Growth Index, in fact, is defined as the performance of Russell 1000 companies with higher price to book ratios and higher forecasted earnings growth. So in deciding which stocks in the Russell 2000 go into growth, which stocks go into value, the indexers simply look at price to book and earnings growth. In value, it's companies with low price to book ratios and low growth rates, earnings growth rates. So they're only looking at those two metrics. The Bloomberg Pure Value Index is a long-short index, again, going long stocks with the lowest valuations and short stocks with the highest valuations. They look at a lot broader mix of valuation metrics. They look at price to book, just like the Russell people. They look at price to earnings, though. They look at cash flow to price. They look at enterprise value to EBITDA, and they look at forecasted forward-looking price to earnings ratios. So they're looking at a lot more valuation metrics than just price to book and earnings growth. In fact, Pure Value doesn't look at earnings growth. It looks only at valuation. So the key thing to remember here is when you hear people say, well, value has been severely underperforming growth for years now, since the end of 2006, that is not true for all valuation metrics. It really depends upon which value metric you are looking at. If you are looking at price to book, that's true. If you're looking at price to sales, that's true. But here's another one. And this is one we've pointed out before in deep dive investing, and it's enterprise value to free cash flow. Enterprise value is just the value of a company's stock and debt. So market cap is just a value of the company's outstanding shares. So it's basically the number of shares outstanding multiplied by the price per share. And but it doesn't include the value of the company's debt. Enterprise value also adds to the equation the value of the company's net debt. So if a company has a market capitalization of 10 billion and they have net debt of another 5 billion, their enterprise value would be 15 billion. Okay? So think about what that does. It basically means that it rewards companies for having low net debt, or in fact, a net cash position, because it lowers their enterprise value. So if you use enterprise value as the numerator on a valuation metric instead of price or market cap, you are going to reward companies with low debt and penalize companies with high debt. And if you remember back or flip back in your PDF there to the slides where I showed you what groups didn't perform well towards the end of a market rally back in 2002 to 2007, and in this bull market, you'll see that leverage is something that does not do well in the latter stages of a bull market. And therefore, if you look at valuation metrics that take leverage into account, that penalize companies for having a lot of debt, they're going to tend to perform better than other valuation metrics at this stage of the cycle. So I really wish people would stop talking about value and growth in such like it's a done deal terms, and instead look at it with more granularity. There's a lot of different ways to value companies. It's not just price to book, it's not just price to sales. In recent years, metrics like enterprise value have gained a lot of traction because debt has become such an important thing to look at, especially in a world where interest rates are going up and we're at the latter stages of a cycle likely, and at least entering the latter stages of a cycle when highly leveraged companies tend to underperform. Free cash flow is nothing more than a company's operating cash flow minus their capital spending. So you can think of it as the amount of money a company has left over to pay as dividends or as buybacks or for other purposes. So basically it's free cash flow. As the name suggests, right? It's the amount of cash a business generates that's free for the company to use, not just has to be used to maintain their existing infrastructure, et cetera. So if we look at enterprise value to free cash flow, companies with high enterprise value to free cash flow are going to be considered expensive on this metric, and companies with low enterprise value to free cash flow are going to be considered cheap. And what I did is I just looked over the past year, and this chart goes up through September. And you can see that the blue line is the 20% of companies in the S&P 500 that rank with the lowest enterprise value to free cash flow ratios. And the red line is just the total return, capital gains plus dividends from the S&P 500 itself. This portfolio got rebalanced every month. So in other words, every month we look at enterprise value to free cash flow and reweight the portfolio so it always contains the 20% of S&P 500 companies with the lowest EV to free cash flow. And what you can see here is that clearly the low value companies, the companies that have that rank well on this valuation metric, have outperformed the broader market. They're up by about 22% compared to closer to 19% for the S&P 500. So, not a huge valuation outperformance, but significant over just a year, 3 percentage points. A lot of fund managers would kill for 3 percentage points or so of outperformance over just a 1-year period. You'll also note that the low EV to free cash flow companies actually weathered the downturn earlier this year, the sell-off, better than the broader market. The broader market fell more sharply. And throughout that entire period, you can see how the gap between performance of companies that are cheap on this basis was really high compared to the S&P 500. So not all value stocks underperform, and even though you might have heard value has been underperforming growth. So let's kind of summarize it all up. And again, it's not set in stone, but this is a good indicator you can use as a kind of basic roadmap or guide for the kind of characteristics you want to look for depending upon where we are in the economic cycle. In an early cycle, in an early part of the cycle, when the economy is just recovering from recession, the stock market's just coming off a low, you want to look for low quality companies. Now, I know that sounds almost ridiculous to say, but again, the companies that are the shakiest companies are going to tend to perform best early in the cycle. High risk, high volatility, again, it's going to outperform better. Small cap stocks are going to outperform large cap stocks. Value stocks are going to outperform growth stocks, and companies with a lot of leverage are going to rise the fastest. Now, that doesn't mean you should go out and buy a bunch of really low quality, unprofitable companies just because it's the early stage of the bull market. But it does mean that you should look for companies that maybe have had too much leverage but are surviving the recession, and you might want to look at those in the early stages of a recovery because they can show dramatic outperformance. What do you want to sell early in the cycle? Momentum. A lot of people think momentum would do well at that stage of the cycle. It really does not, because by definition, as the stock market and the economy make a major turn from bear market to bull market, the stocks that perform best during the bear market are not going to perform well in a bull market. Large caps tend to underperform small caps. Doesn't mean you shouldn't own any large caps, obviously, but it does mean that you should maybe weight a little bit more of your portfolio in favor of small. And you do want to maybe de-emphasize quality and look at some lower quality stocks. Again, doesn't mean you need to run out and buy junk companies, but it does mean that some of the high quality companies that investors used as a place to park money during the downturn are going to face a headwind, where some of the lower quality companies that may have had to go through some sort of restructuring or cost cutting or have been really beaten up during the downturn may be a good place to look for some bottom fishing in those names. As we move into the mid-cycle, what works? Momentum. High risk still works, but momentum moved from being a really bad thing to have to being a really good thing. And that's because at that stage of the cycle, you're moving into a period where what has worked continues working, and what isn't working tends to continue not working. High risk, again, because the economy is growing at a steady clip, higher risk companies, small cap companies, high beta companies, and value all can, looks like I actually have high risk there twice, but I mean to say high earnings risk, high earnings volatility, and high price volatility. and value, which, as I said, tends to perform better when the economy is kind of coming along, because these tend to be more cyclical companies. So mid-cycle, a great time to look for those groups. What doesn't work well in mid-cycle? Large caps do slightly underperform small caps generally, and quality stocks still lag throughout most of the mid-cycle because investors are focusing on other things like cyclicality, exposure to an economic expansion, and momentum, and stocks that can move. Quality stocks tend to be a little bit more staid and slow moving and just sort of steady eddy, and that's not what a lot of investors are looking for in the mid-cycle. Doesn't mean you shouldn't own some of them, but you might want to put a little bit less money in those high quality names, even if you're buying and holding them for a long term, and a little more money in stuff with more risk in the mid-cycle. What works in the late cycle? Momentum, again, very interesting here. A lot of people think momentum wouldn't work late in the cycle. It actually works really well. It's one of the best performing factors because, again, companies that perform, as we've talked about before, in the final stages of a market rally, you tend to see very powerful gains for the stock market. In fact, the stock market's up an average of about 58% in the final 2 years of a bull market and about 25% in the final year. So stocks that are doing well tend to continue doing well in that final sort of melt up for the stock market. High quality finally starts to really outperform at this stage of the cycle. I won't go into this too much detail here, but one of the factors is that you tend to see a pickup in stock market volatility towards the end of a cycle. The frequency and duration of sell-offs begins to increase, corrections begins to increase, and investors tend to gravitate towards high quality in those environments. We did an issue on this last spring, I believe in March or April, for Deep Dive. You can look it up on the archives about quality as a metric. And in the last 2 cycles, we've seen portfolios of S&P 500 companies ranked by very simple measures of profitability, right, like return on equity, just blow away the broader market. What's really great about this, though, is that these also do well as we enter a bear market phase, as I showed you earlier. It's a great bridge. It's a great bridge thing to own, right? Because it tends to perform well at the tail end of a bull market and in the early stages of a bear market. Oftentimes, the stock market doesn't go straight up, find a bull market top, and then have a V-shaped sell-off. Often, for the first few months, sometimes longer than that, of a bear market, the stock market only drops gradually. For example, a lot of people don't remember, but from late 2007 till the middle of 2008, the S&P 500 only fell sort of 15 to 20%. So it was a bad correction, but nothing like the 50+% we saw by that end of that year and in early 2009, the big sell-off, one of the worst in history. So the economy, the stock market did not plummet directly coming out of the gate. It saw a lot of volatility. It never regained those late 2007 highs, but it didn't fall that much until after the summer, starting in the summer of 2008. And so what happened was a lot of investors were still long stocks, and high quality worked really well up until the summer of 2008. So it's a great thing to buy if you think you're in the late cycle, because these stocks can also carry you through the top. They don't just work at the end of the bull market. Large caps are definitely outperform small caps, and that outperformance becomes more obvious later in the cycle. Yet another way of saying that market breadth tends to deteriorate at the tail end of a bull market. More and more stocks start falling, more and more industry groups start underperforming. Low risk and low volatility and growth over value. Low risk, low volatility, we kind of covered that. Growth over value, again, value stocks tend to be cyclical. So as the economy slows, they tend to underperform, and growth picks up in terms of outperforming value. These are secular growth companies that can continue to grow even when the economy weakens a little bit. So growth can be something to look for at the tail end of a bull market. I know that seems a little counterintuitive. You'd think, I want to own value, I want to own cheap stocks at the end of a bull market. It's actually the opposite. The final thing is late cycle sells. Again, I can't emphasize this enough. Companies with high leverage, a lot of debt, big problem. Low quality companies, big problem. High EPS volatility, another form of quality really, a big problem. So those are groups that you want to look to sell in that late stage bull market. What are the cycle stage characteristics? We've covered a lot of this, but the early cycle is basically the transition from a bear market to a bull market. You start to see green shoots in the economy. We like to use LEI for spotting those. And then in the actual early stages of the economic expansion, you should see a strong, or at least sort of strong, snapback in economic growth. The yield curve should be steep or steepening. Reason is that typically at the tail end of a recession, the Fed has cut rates aggressively, pushing down short-term rates. But as those green shoots start to appear, the market participants start bidding up the yields on longer-term government bonds in anticipation of a return of economic growth, inflation, and maybe the Fed eventually needing to hike interest rates again. So the yield curve really steepens out and is usually very steep at the end of a recession. So you'll typically see in the early stages of a recovery a pretty steep yield curve. You'll also see on a technical side, I like to look for the market to break higher through that 40-week or 200-day moving average, whichever you prefer to look at. Mid-cycle, usually a year or two into the rally, this will pick up. The growth will slow down a bit from the very high rates early in the cycle, but so you'll see it kind of come down to more of a trend rate. There's a lot of argument over what is a trend rate of economic growth in the U.S., but I would say just sort of a middling rate of economic growth, somewhere around 2 to 3%, maybe a little bit on either side of that, would be kind of a trend rate. I think the consensus is close to 2% right now is what the trend rate of economic growth is. You're going to see periods where it's a little higher than that and periods where it's a little lower than that, but in the mid-cycle it should be just kind of humming along. You will see in some cycles soft patches, and I showed you those a little while ago in the current bull market back in 2011 and 2015, 2016. The market will generally during these periods be in a steady uptrend with most corrections, most pullbacks stopping around the 40-week moving average, just under the 40-week moving average. And typically you're going to watch that 40-week moving average steadily climbing. I showed you there were some nasty corrections that were kind of like mini bear markets during this bull market back in 2011, 2012, and 2015, 2016, where the 40-week moving average rolled over with the market, and it looked like it might be transitioning into a bear market. In fact, I thought that was a very high risk back in late 2015 and early 2016. But generally speaking, the stock market will be above the rising 40-week moving average. Late cycle, you're going to see usually the yield curve at this time is flattening, and that's because the Fed is hiking rates. Oftentimes the yield curve eventually will invert. You will also typically see it remain flat or slightly inverted for a long period of time before the cycle actually ends, but you will see a flattening yield curve. Typically you will also see some, we'll call them brown shoots maybe, as the opposite of green shoots. You'll see some early signs of economic slowdown or softening. Typically also market volatility picks up and inflation picks up, which is usually why the Fed is hiking interest rates. And market breadth will begin to break down because, again, small caps underperforming large caps. And then the final cycle, recessionary bear market, the economy is weak. The yield curve is probably steepening as the Fed cuts rates. And the market generally trending below the 40-week moving average. So those are kind of the characteristics. What stage are we in right now? We are in the mid-cycle, kind of transitioning to the late cycle. I tend to believe we're entering the late cycle this year, and it's hard to know how long it's going to last. But we are getting some mixed signals now, but definitely the signals for a late cycle have begun to pick up this year. Last year, it was pretty much clearly a mid-cycle market, pretty classic mid-cycle market actually. This year, we're beginning to see some signs of late-cycle characteristics. Here's what I mean by that. Mid-cycle characteristics we're seeing now. The US economy remains very strong, LEI consistently positive as I showed you. Typically in a late stage bull market, you will see some signs of softening in the form of at least a few negative readings on LEI. We haven't seen that since 2016, very unusual for a late cycle. Typically at this stage of the cycle, in the late cycle, you'll see small caps underperforming large caps in a late cycle. We're not seeing that. Small caps have been outperforming large caps so far this year. You could argue that over the last month or two, that has reversed a little bit, but year to date, small caps are still pretty strongly outperforming large caps. They definitely outperformed large caps coming out of the correction earlier this year. So that's unusual for a late cycle. That's more of a mid-cycle characteristic. Something to definitely watch. If large caps continue to outperform small caps, if measures like the New York Stock Exchange Advanced Decline Line and the Russell 2000, for example, begin breaking down even as the S&P 500 goes up, that's going to be a very clear sign that the economy is in the late cycle. We're not quite there yet. Typically in the mid-cycle, high-quality stocks perform in line with or underperform the market, the broader market. And actually quality has underperformed the broader market so far this year a little bit. Not a lot, a little bit. We recommended some quality stocks back in February, March, high quality stocks. Again, we're very selective though. We screen based on these various characteristics and use that to develop a list of ideas for further research, look for trends there. And we picked a couple of high quality companies, in particular Zoetis, the pet healthcare company, and Verisk Analysis, which is an insurance data provider, and those stocks have both done really well. Typically, in the mid-cycle, the yield curve can be flat but not yet inverted. It can be flattening. Usually, there's about a 20-month lead time between the yield curves first inverting and reaching a peak for the stock market, and that's based on historical data going back to the 50s. So about a 20-month lead time. So yield curve hasn't even inverted yet. So when it does invert, it could be as long as 2 years before the stock market actually, or close to 2 years before the stock market actually peaks out. So again, we haven't seen that yet, even though the yield curve is flattened. And so it's hard to say. That's not a typical late cycle. That's more of a mid-cycle scenario. Late cycle scenario characteristics: inflation picking up, especially in commodities. Definitely something we're seeing now. We've seen oil prices skyrocket, as many of you are keenly aware. We've seen wage price inflation begin to pick up a little bit. We've seen inflation pick up overall. In fact, that was kind of the driver of the scare earlier this year in the stock market, was a pickup in inflation. Not across the board, but definitely on the commodity side. Growth is outperforming value on traditional metrics, and actually on a lot of even EV to free cash flow, which I showed you earlier as being one of our favorite valuation metrics at this stage of the cycle. It's only beating the broader market by a little bit. So growth has been doing really well, and typically that is characteristic of a late cycle market. Some pickup in volatility. Yeah, that's a little, we saw a big jump in volatility earlier this year, but since then, the S&P volatility index has collapsed back to very low levels. But typically you do see more frequent corrections and pullbacks with volatility spikes in the late cycle. So I still think that could have been kind of a warning shot that we're entering the late cycle earlier this year. Typically the Fed's raising interest rates or has gone through a major hiking cycle when we enter the late cycle. That's definitely true. The Fed has been consistently raising rates now. The yield curve is flattening, getting near to an inversion. Again, as I kind of put that same characteristic in both mid-cycle and late cycle, because even though the yield curve does tend to flatten as you move through the mid-cycle, there's that rule of 20, roughly 20-month average lead to the peak in the market from the first inversion. We haven't quite got there yet, but we've gotten very close. The other thing I'd point out is that high leverage stocks have really started to massively underperform the broader market. And that is very characteristic of a late cycle. So you can see that almost all those late cycle characteristics that I have on this slide have only become apparent since the end of last year, this year basically. And some of them we got some hints, like for example, inflation, but those late cycle characteristics, most of them have only become really apparent this year. And so even though there's some sort of cross signals there, whether we're in the mid-cycle or the late cycle, it looks to me that we're transitioning from the mid-cycle to the late cycle. It's not so important to get it exactly right. You probably can't time, even after the fact, exactly when that change happens. It's kind of a transition. It's a steady flow from one cycle state to another, one stage to the next. And that's where I think we are. We're between the mid-cycle and the late cycle, entering the late cycle. And those are some things to watch for when we know we're really in the late cycle. So what stocks should you buy and sell now? Momentum, as I showed you, momentum works in both the mid-cycle and the late cycle. So it's something to look for. We have a number of different ways we measure momentum. And those stocks have been outperforming the market all year. Most of them are simply based on price returns. So is a company doing well compared to the broader market over the past 9 or 12 months? Those are very traditional measures of momentum. I'd never, ever, ever recommend just doing a screen and buying all the stocks that pop up. I think that's just idiotic, frankly. But I do think that you can look at stocks that have been performing well and develop a list of names for further research, which is exactly what I've been doing. Companies that have been performing well. I then look at other fundamental measures as well, of course, obviously, and try to determine, what are the fundamental drivers and look for trends. And that's helped us identify some trends, which I'll be sharing with you, some specific names in part 2 of this presentation, which will just be coming up in a couple of days here. Buy high quality. This is something we've been saying for a while. Again, it's a bridge characteristic. It is a great thing to own at the tail end of a bull market and the early stages of a bear market. So even though not all high quality stocks have been outperforming the broader market this year, I think that's a small price to pay, because as we enter more and more into the late cycle, they will start to outperform, and then past the top, if we don't time that top exactly, then that's a great area to hold early in a bear market as well. It'll help you protect your portfolio. Large caps. Small caps have been outperforming, and we still like small caps, but I think that it's time to start putting a little bit more attention back to the large caps. So if you've been overweight small caps, this is time to maybe put a little bit more money in bigger companies, because we're beginning to see some signs of late cycle. Large usually outperforms small in the late cycle. Small cap stocks are also very expensive relative to the broader market right now. And this is kind of interesting, I was looking at the net debt to equity for small cap stocks in the Russell 2000, and their leverage is really perked up here over the last couple of years. They've got a lot of debt relative to large cap companies. Again, leverage is a terrible thing at the end of a market rally and in the early stages of a bear market. So another reason to be a little cautious of small caps. Not time to go out and dump all your small caps or abandon the group. You could very easily see another leg higher. In fact, I think it probably will this year. But this is time to start preparing for this major shift, very important shift. Some value factors are working. We like enterprise value to free cash flow. We've been talking about that since late last year. It's helped us identify some winners. But I do think you need to be thinking, I hate it when pundits come out and say, you need to buy growth or you need to buy value. At this stage of the cycle, I think you have to be very selective. And remember, that's not the only characteristic out there. There are others like momentum and quality, which we have a lot more conviction in at this stage of the cycle. I think you need to focus on certain value factors that are working, like EV to free cash flow, and need to balance that with some more growth-orientated companies with strong earnings and sales growth. Sell high leverage stocks. These stocks are already underperforming. We won't be recommending any this week to short, but it is something I'm looking at, honestly, as we move through the latter part of the cycle. Are there some of these heavily indebted companies that we might be able to sell short that could help protect us when the economy and the economy starts to slow and the stock market starts selling off? And you also want to sell lower quality companies, especially companies with a lot of earnings volatility. Those stocks are also already underperforming since the January top for the market. So these are some of the things that we're looking at right now. These are 6 characteristics, 4 to buy and 2 to sell. And these are characteristics we're looking at and developing a list of stocks. Part 2 of this issue will be coming out in just a couple of days. And in it, I'll tell you some specifics, some stocks that we actually want to add to our active total return portfolio that exhibit these characteristics and that we've done further research on. We had a big list that we developed, and I've been going through them for the last several days, and we've narrowed down to just a handful of names we think are interesting buys right now. So stay tuned for that. Again, my name's Elliot Gu, and this is Deep Dive Investing Issue for September of 2018.